One of the questions I always get is, what should financial analysis actually look like in a case? I've coached 302 Haskane teams to over 180 podium finishes. We start with situational analysis, examining the existing financial statements to understand the current picture before we model any changes. This is part of the Case and Excel Mastery series. Turn numbers into compelling insights. Let's break down how you do a strong situational analysis using ratios and comparisons. Situational analysis means digging into the provided financial statements. Spot the big changes in the key lines. Use ratios to compare the firms on a relative basis across profitability, short-term solvency, activity, efficiency, cash conversion cycle, financial leverage, and value. Remember, these ratios are industry dependent. You need context to know where a number is good or bad for that specific company. For profitability, look at the profit margins, return on assets, gross return on assets, and the return on equity. Higher is generally better, but compare to industry peers. For short-term solvency, current ratio and quick ratio tell you if a firm can pay its bills. Ideally, higher is safer in the short term. These ratios help you answer, is the company financially healthy enough right now to even consider big changes? For activity and efficiency, total asset turnover, receivables turnover, inventory turnover, higher is better. It shows how well assets are being used. Lower average collection period is better. The cash conversion cycle combines the days inventory outstanding, days receivable outstanding, and days payable outstanding. It shows how quickly the firm turns resources into cash to pay its bills. In terms of financial leverage, debt ratio, debt to equity, interest coverage allows you to understand how much debt is carried by the firm versus equity. Debt is senior and requires interest payments. Equity brings ownership and potential loss of control. This is industry dependent. Some sectors are naturally more leveraged. Finally, look at market value indicators like the price earnings ratio to understand the market's perception of growth prospects. Putting it together, what does the current financial health look like? What are the strengths and weaknesses? How does the firm compare to its industry? This situational understanding becomes the foundation for credible solution modeling and recommendations later. There you have it, a clear approach to situational financial analysis using ratios for profitability, solvency, efficiency, leverage, and value. This is part of the Case, Finances, and Excel Mastery series. Turn numbers into compelling insights. Drop a comment. Which areas of financial analysis, profitability, solvency, efficiency, or leverage do you find the hardest to interpret in cases? Subscribe and hit the bell for the rest of the series. Cam Welsh out. Understand the current picture before you change it.